We've all been there. Streaming the latest must-watch show and it starts to buffer. Or you're on an important work call and the audio starts to cut out. If you're looking for a new broadband provider, right now we're offering Which members a £25 Amazon gift card just for switching via our website. Simply head to broadband.which.co.uk to compare the current deals and find the right provider for you. What's more, if you switch to Which recommended provider plus net, we'll upgrade that £25 gift card to one worth £50. This offer is exclusive to Which members, so if you're not already a member, then just head to which.co.uk/podcast offer to grab a Which membership for 50% off the usual price. Then go to broadband.which.co.uk to complete your broadband switch. But hurry, you have to switch before the 23rd of April to be eligible for the gift card. T's and C's apply.
With Trump's tariffs causing turmoil on the markets over the last 2 weeks, could mortgage rates actually be one of the big winners? I'm Lucia Ariano and this is Which Money. Hello and welcome to the show. And joining us, as usual, when we talk about anything to do with the housing market is our mortgage expert, Stephen Maunder. Hello, Stephen.
Hi, Lucia.
And also another familiar voice for our listeners, Aneisha Beveridge, Head of Research at Hamptons. Hello.
Hello, hi.
Well, thank you both so much for coming in today. Where shall we start? Is it fair to say it's been quite an uncertain time for mortgage holders and mortgage rates at the moment?
Well, yes, I guess we're actually we're on the cusp of some uncertainty, which has really started to kick in over the last week or so with all of the, as you'll have read in all of the headlines, Trump's tariffs and their knock-on effect on the markets. It has actually been, for sort of the last 6 months, it's been a fairly slow, steady, sort of gentle drop in mortgage rates without really having a huge impact perhaps on repayments. Whereas I think now in the last week we've seen a lot more lenders reprice. We've seen a little bit of competition to be at the top of the charts, which we hadn't had for a while.
Yes, indeed. I think it's been more of a roller coaster for the markets than it has been mortgage rates, actually. But yeah, as you were saying, I think some of the good news we've seen over the last week is mortgage rates starting to kind of drift down a little bit. So a little bit of potential good news for the housing market there.
And what kind of ballpark then, in generally speaking, what kind of ballpark are mortgage rates in at the moment?
Well, they vary hugely depending on how big your deposit is, what your kind of financial circumstances are. But one of the sort of thresholds that we often talk about is around 4%. And we've seen quite a few more of the big lenders start to bring in sub 4% mortgage deals. And it's the first time we've had those around for quite a while, actually. Most of the time, they're only available to people with slightly bigger deposits, so taking out 60% loan-to-value loans, 50% loan-to-value loans, that sort of thing. But actually, some of the bigger falls in mortgage rates that we've seen over the last couple of weeks have come in those high loan-to-value brackets, and they're the ones most often used by first-time buyers.
So good news for first-time buyers. So, you say that they've come down. How much have they come down in the last couple of weeks then?
So I made some notes on the first-time buyer side specifically. As listeners to the podcast may know, I often say about first-time buyer low deposit mortgages, people tend to get left behind when rates come down. But I've been monitoring a market-leading rate from back in December from Nationwide. This was back when 90% mortgages were about 5%, a little above. So that 5.14% deal, 2-year fix at 90%, is down to 4.82% now. So we've lost 0.34 percentage points I've written here, which is obviously quite hard to put into repayments. But I'd say, for example, maybe if you were borrowing, say, £250,000 over, say, 30 years, that might knock around about £100 perhaps off your repayments a month, maybe at the most, maybe slightly less, £80 to £100. At the other end of the market, as Aneisha says, we were kind of around that market leading a few months ago, being around 4.1, 4.2. I think we're at 3.89 now on the 2-year fix. So rates aren't tumbling, but I think the big thing really is that the hopes that the base rate will be cut faster and further than expected could have a further downward pressure in the next sort of 6 months or so.
Yeah, it's that's kind of drifting. That's the volatile bit, isn't it? And that's what's at the whim of kind of Trump's tariff announcements, depending on how he feels and wakes up every morning, I think, and lots of other things. But I think one of the other good things that we've been talking about as rates are coming down is it enables people to borrow more. So that really kind of helps with affordability. So your typical first-time buyer who's purchasing maybe, say, a £400,000 home with a 10% deposit, actually the fall in mortgage rates that we've seen will enable them to borrow at least kind of £19,000 more, which isn't an unsubstantial figure really, and that sort of helps offset some of the stamp duty increases we've seen. And there are some lenders kind of tweaking some of the affordability kind of stress testing as well at the moment. So it seems to be getting a little bit easier for borrowers, which is good.
Can we just rewind a little bit to tariffs? And our listeners might be wondering, why are they having this effect on mortgage rates?
The tariffs are fairly big in the sense that they can have a big impact on global economic growth more than anything. And generally, the UK is actually thought to have been quite resilient from it all so far. So around 80% of economic growth in the UK is service driven rather than coming through kind of manufacturing or construction. So yes, we do have some kind of big manufacturing things, particularly pharmaceuticals and some of the car exporters who will face some challenges here. But as a general economy, we're probably quite well cushioned from all of this compared to places like Germany and France and things like that. But I think generally the consensus is that these tariffs will probably put downward pressure on interest rates, if anything. There's a bit of a school of thought that we might start to see some of the goods that Asia would typically export to the United States start to be dumped into Europe. And that might cause the prices of goods to fall, potentially reduce inflation, and that might enable the bank to kind of lower rates a little bit quicker. Then there's also the impact on businesses to consider and kind of broader economic growth. So will businesses start to kind of have to lay off workers because they're kind of seeing their costs increase? You've got those just general disruption to global supply chains, general uncertainty, and that might just weigh on economic growth, and that might kind of trigger the bank to be a bit more cautious and potentially bring rates down as well. So there's lots of kind of moving parts to this. So we're going to have to see what really unfolds. Sorry, that was a very long answer because there's a lot going on there.
There is a lot going on. I mean, let's bring in the base rate then, shall we? So the next decision, I believe, is going to be next month. And it's largely expected that it's going to be cut, isn't it?
Yeah, almost certainly at this point. So we're at 4.5% at the moment, going down almost certainly to 4.25% in, I think it's 8th of May, something like that.
It's May, isn't it?
And yeah, as Aneisha said, we're seeing markets kind of reacting to all of the wider kind of world trade turmoil as it now is, which makes it sound incredibly severe, doesn't it? But I think the mortgage side of things is a bit of a bright spot for people in this country, whereas maybe strongly advised no one really looks at their pension pot too much at the moment because the volatility is not great for that, but ride it out. But I think we were originally thinking, that we may end 2025 with the base rate at around 4%, which is 2 cuts basically. So say one in May to 4.25 and then one later in the year. Economists are now saying possibly 3.75. I've even seen a few saying 3.5. Yeah. And obviously, while this is good news, particularly if you're remortgaging or if you're looking to buy a house, as Aneisha said, with your affordability, we have to factor in the fact that as this becomes more expected, banks are already starting to price their deals in with the expectation this will happen. So I guess what I'm saying is on 8th of May, say the base rate goes down, we won't necessarily see mortgage rates go down by that amount because we're already seeing them go down. And that brings us on, I think we were talking earlier about swap rates.
Yes.
Which Aneisha would like to explain.
You're going to put this one on me. I would love to explain this, Stephen. So swap rates, the simplest way I think of explaining them is it's a financial instrument used by lenders. It's what they pay to borrow money that they then lend to consumers and people like us with mortgages. So they essentially borrow from these financial markets. It's a bit of an insurance hedge in some ways as well. But yeah, when swap rates come down, it means that lenders can borrow money at a cheaper rate. They pass that on in the form of lower mortgage rates. So that's what people like us analysts were always kind of measuring and watching swap rates more than actual mortgage rates, really.
It feels like an interesting time because usually when we're having these conversations about mortgage rates, we're talking about inflation.
Yes.
Inflation hasn't really come into the conversation much yet, and because usually we're talking about whether or not we're above the target of 2%, which at the moment we are, and yet the base rate's coming down. How does that work?
Again, it's always the Bank of England are trying to look forward with a lot of this. They're trying to anticipate what's going to happen to the economy. And although they are sort of targeted to primarily get kind of inflation back to around the kind of 2% mark, they're looking at forward indicators and they can see that the economy is weakening in some areas, particularly around the labour market. The labour market statistics, there were some out today this morning actually, and they're a little bit contradictory, to be honest. Unemployment hasn't really moved, but actually the number of people who are on a payroll has fallen quite a lot between February and March. Earnings growth is still kind of holding up quite strongly, which again is quite good news from an affordability perspective. But that's a figure that the Bank of England have been trying to kind of, or hope that it kind of came down a bit more in line with inflation. So there are lots of moving parts in all of this, and they're not just looking at kind of core inflation, they're looking at economic growth and kind of weaknesses around global trade as well.
Yeah, inflation can be a bit of a blunt instrument, I think, as well in that respect. That if it's 2% and it changes to 1.9, you might see headlines like inflation has sunk, or if it goes up to 2.1. Inflation, obviously, inflation is kind of looking back at a previous month as well. A bit like when we look at things like land registry data, it is kind of retrospective rather than what's happening right now. But also, I think that, as Aneisha says, it's almost when you see the inflation data, and also when you see the Monetary Policy Committee notes on the base rate, the notes are more interesting than the actual figure usually. So we've seen consistently the Bank of England say that we're urging caution, we don't want to release the brakes, things like that. And what I quite like looking at when it comes to the base rate vote is the margin of the vote as well. So you have, I think is there 9 people in the MPC, is that right? Yes, so. And it's a majority vote every month. So if you get a vote where it's 5-4 or 6-3, you think, there is a little bit of uncertainty here about should we hold for another month? Should we go now? And it kind of used to be the case that the base rate cut tended to come maybe the month or the meeting rather after you expected it to. It's kind of like you think, they might go this month. No, actually they're going to hold off. But I think at the moment the downward trajectory is on. I think we may still see inflation be a little bit up and down and a bit bumpy over the course of the year, though. But I don't think it will have a huge impact on the Bank of England's longer term plan unless we see something very volatile happening. And one thing we've learned over the last kind of decade is that could happen at any time.
I was talking to one of the economists at Warwick University actually last week about all of this, and he was kind of playing it all down and saying, actually, I think the UK will kind of be okay, as I was saying earlier, because we're quite a service-driven economy. But there are still things that can go wrong. And if financial institutions start to become a little bit sort of cash poor, then you can start to see kind of fragilities in the economy, and that can kind of trigger longer and have much bigger implications. So, there's definitely a little bit to be cautious about at the moment. But generally, the UK seems to have kind of got away with it so far.
And should the base rate drop, 2, 3, 4 times this year, potentially to 3.5%, as you said earlier, Stephen, what does that mean, in theory, for mortgage rates? How low might they go this year?
I think if you speak to brokers, they will tell you that lenders are pricing incredibly competitively already, and the margins can be very, very low for these kind of top rate deals, which is why you see things like quite large upfront fees and things on the top rate deals, because it's got to make the money somewhere. But I don't think, let's say the most extreme expected case happens, let's say we're at 4.5%. I think we might end the year at 3.75, but let's say we end it at 3.5. That doesn't mean those 3.89% top rate mortgages will be 2.89% by the end of the year. I think it would be a very brave person to expect things to drop to 3% or below this year, I think. Maybe mid threes, perhaps. That's a 3.3, 3.4, perhaps.
Yeah.
That's what I'd guess, perhaps.
Yeah, I agree. I think what we'll probably see is, again, some of those high loan-to-value mortgages become a little bit cheaper and become a bit closer. We'll see mortgage rates become a bit more kind of tightly packed, I guess. Maybe a few more sub 4% mortgages around, but the change in expectations of interest rates has mainly happened for where they think rates will move or fall to in the next 12 months, not necessarily over the next 3 to 4 years, which is another kind of part of the calculation that makes up a mortgage rate. So even if suddenly financial markets think the base rate will fall to 3.5% by the end of this year rather than 3.75%, that doesn't mean, as Stephen was saying, that 0.25% will be fully passed on to a lower mortgage rate. So yeah, our expectation really is that we probably won't see mortgage rates drift down considerably more from where we're seeing today.
It's a bit of a guessing game, really. There's so many factors influencing it.
Yeah.
I think over 1 million people still to remortgage later this year. We'd love to come on here and say, oh, there'll be 3% by the end of the year, but downward pressure. But I think we have to keep our expectations in check a little bit.
Absolutely. There's a lot of risk factors around at the moment.
Well, it hasn't felt as hopeful as this, I don't think, from where I'm sitting for a long time. So that at least is good.
I think last time we did this podcast, we were just saying that everything was like quite bad. So it's quite nice to hopefully have something positive to say.
We've definitely had some stability, as you were saying, for the last 6 months as well. And I think that's generally just really helped the housing market as a whole, but particularly borrowers. So it was a bit of a roller coaster ride for a couple of years, but things have kind of leveled off a bit, and that has helped.
Okay, well, let's pause for a moment on that positive note, and we'll be back in a moment with advice for anyone looking to take out a mortgage or remortgage soon. So it looks like mortgage rates are on this downward trajectory. What does this mean then for people who might be coming up to the end of their mortgage, their fixed mortgage, or looking to take out a mortgage? Should they be holding off?
Well, for most people rolling off a 5-year fix will still end up paying more today than they probably would have been paying. But we're actually now at the point where a lot of people that took out coming off a 2-year fix will probably be remortgaging at a lower rate than what they faced 2 years ago, back in 2023 when rates were rising.
Horrible period.
Yes, not the best time, but I mean, people didn't have too much choice, to be perfectly honest, and they just had to kind of deal with it.
Yeah.
Whether kind of people should hold off, I think it's a risky business doing stuff like that. And I always say to people, you just have to deal with what you can kind of see and what's in front of you today. Our expectation again is that we don't really expect rates to kind of fall too much more. But things are moving so swiftly, so who knows?
If you're buying a home, if you're looking to remortgage, you can lock in a rate now and then switch it if rates do fall significantly between now and the time you come to take the deal. I think what's really interesting is that the relationship between 2-year and 5-year fixed rates is quite complicated now, I think. I think we did have a sort of a system maybe 6 or so months ago where it was, if you want a 5-year fix, you can maybe get it 0.5% cheaper, although obviously you're locking in your rate, you've got the certainty, but markets are expecting rates to fall. Yeah. Whereas now we're kind of reaching the point that the gap between the average 2 and 5-year deal is 0.03% now. So I think when I looked at the Moneyfacts demand data earlier, most people are still looking to get a 2-year fix in this hope that, as the base rate falls, rates will drop over the next couple of years further. But it's not as cut and dried as it was maybe 6 months ago, where it was, if you want a stable rate for longer, take a 5-year fix, but you may have to in 2 or 3 years be thinking, I could have got a better deal. Or if you were willing to pay a bit more but you want that flexibility, take a 2-year. Now I think we're getting back to the days of pick a fixed term based on your circumstances, rather than based on what you think will financially be the better option, because there's so little to choose now.
Yeah, and fees as well. I mean, fees are one of those components that a lot of people don't talk about, but they can have a huge impact on actually what you end up spending on your mortgage over the long term. So yeah, you really have to do the maths when you're looking at the difference between taking out a 2-year or 5-year. Sometimes you'll see mortgages that are 2 years, they might be a low rate, but they can have quite a big fee attached to them. And then sometimes you're not lot better off kind of doing that. So, yeah, you do have to really do your sums with this sort of thing.
Yeah, I don't want to criticise Santander specifically here, but it was just because it was such a high-profile deal around about maybe 6 or 8 weeks ago. Santander kind of came in at the 3.99. It was like first below 4% in a little while. It only lasted about 2 weeks for a variety of reasons, including demand. But that was tagged with a fee, I think, $14.99. So, as in 1,499, not £14.99.
If only, hey.
So, your average mortgage fee might be, most commonly we see $999, so around £1,000. But that market-leading deal below 4% did have the £1,500 fee. And as you say, that's the kind of situation where you start thinking, well, if you get a deal that's got a slightly higher rate but only a £500 fee, you could be much better off with that than the top deal. Yeah. So yeah, that relationship's really interesting as competition grows. I think when we were in the era of very low mortgage rates, when people were taking out mortgages around 2%, it was very common for all of the top deals to come with very high fees because lenders were really pushing.
Trying to find something, yeah.
But I don't know what you've seen, but I do think recently things have kind of flipped a little bit in terms of the competition, which is lenders have at times been almost reluctant to be the very cheapest deal because they end up taking it down within a week because they get inundated with applicants, and they will only have a certain amount of budget set aside for that deal. So I think it's a really interesting relationship between them at the moment.
And what about tracker mortgages then? Because if you're on one right now, you might be reaping the benefits. Are these something that you would recommend? I suppose also for anyone who's not familiar with them, how do they work?
Okay, so tracker mortgage is the most kind of common type of variable rate mortgage, and they are affected by the Bank of England base rate. So they will usually follow the base rate plus or minus a margin. So it might be base rate plus 1%. So let's say if it's 4.5 at the moment and it was base rate plus 1, it'd be 5.5 or minus whatever else. As we see the base rate fall, obviously tracker mortgages will fall, may become more attractive. But I don't envisage a huge rise in products in that area, or even really a huge rise in demand, to be honest. I don't know whether you do. I feel like the age of trackers being quite big is maybe over.
Yeah, I mean, there are some crazy stats actually that were sort of pre-financial crisis. The vast majority of households would be on a variable mortgage, not necessarily a tracker, but the large majority would be on trackers. And actually, it's only over the last kind of decade, really, that fixed rate mortgages have become so popular in the UK. And some of that is down to some of the affordability kind of changes that were brought in around 2014 to help sort of protect the market and ensure that people kind of knew what they were having to pay. And I think there's still a big part of that. I think we've become quite reliant on knowing how much our mortgage is going to be every single month. And particularly for first-time buyers, it's some of the only ways now that lenders will give them a mortgage is so they know that the interest rate is essentially not going to go up.
And you mentioned for first-time buyers. So for first-time buyers or anyone buying a place, they will, of course, be affected by stamp duty. And there have recently been some changes to that. I mean, rates coming down, potentially are they kind of outweighing or balancing up that stamp duty change?
Yeah, so there have been some pretty big changes in stamp duty, to be perfectly honest, over the last month or so. So we're kind of estimating that first-time buyers are now going to have to spend an extra £403 million a year in stamp duty. Most first-time buyers still won't pay stamp duty, so that's important to kind of point out. But the share of first-time buyers who are paying stamp duty is going to kind of triple. And some of them will face up to an £11,250 increase in their stamp duty bill. And that's cash that you've got to find. It's not particularly easy to borrow. They're most likely to be people who are buying in London, the South, where properties are more expensive. And it's here where we've still seen a little bit of kind of fragility in the market. But some of our latest research shows that actually, surprisingly, first-time buyers have been very, very resilient. They purchased a record 33% of homes sold in the first quarter of 2025. And that figure just seems to kind of continue rising. And even in those higher price brackets where first-time buyers are most impacted by the stamp duty changes, they're kind of holding up well. It's actually movers who seem to, or upsizers who seem to have kind of held back a little bit more.
Yeah, I think there's also an element of eventually you've got to take the leap.
Yeah.
I think there was a very long period of time where that pent-up demand was growing because of, as you say, affordability issues, higher mortgage rates, etc. And I think at some point you just go, well, if you're renting, for example, like I know rents broadly may rise at a slower rate this year or even come down in some places like London, but it is still the difference between taking out a mortgage if you can at 5% with a small deposit, even if the repayments are slightly higher than your rent, if it's affordable. You are still building a stake in something you own ultimately, as opposed to paying that rent forever. And it's very difficult for first-time buyers because, A, the affordability has been difficult for a long, long time, but also knowing when to make that move is so tricky. And I think, as Aneisha says, stamp duty is having a big impact. And I think when we finally see the land registry data for March in a couple of months, we'll see, like we had a few years ago with the stamp duty holiday, we'll see the figures go way up and then come back down. But I think that pent-up demand has to start releasing. And I think, as you say, for first-time buyers, it clearly is. And I think we might see that with home movers over the coming months as well, to be honest.
Yeah, it's upsizers in particular who have really held back from the market over the last couple of years, because generally when people kind of trade up the housing ladder, they borrow that extra money to fund moving from, let's say, a flat to a house in the most generic terms. And borrowing that money has become really, really expensive over the last couple of years. And a lot of those people who did own already have just kind of thought, oh, well, I'm just going to wait for rates to fall. And I think now the expectation is shifting, as we've been talking about today, that actually mortgage rates might still come down a little bit more, but not hugely. And that might just kind of, sentiment-wise, might just kind of trigger a few people into moving and just kind of getting on with it this year.
If you're, say, living in a terrace and you want to move up to a detached and it's another £200,000 to do it, you're looking at that going, where am I going to raise that money from? And that then locks the first-time buyers out of. It's an argument that's long been made about downsizing. You know, if you can't get people to downsize, ultimately the market can't move. But also, the second steppers need to move into bigger properties to allow the first-time buyers to move up. So you need a market where the wheels are turning at all levels, and I don't think we've necessarily had that the last few years. So
definitely not, and that's where stamp duty plays such a big role. I mean, we can see in the numbers that people just aren't moving anywhere near as much as they used to. So, and it is those kind of upsizers. They just can't afford to move, and when you're having to cough up sort of potentially well over £50,000 in stamp duty in some places in London and the south, people aren't going to move as often unless their house price is appreciating at a very, very similar rate, which we haven't seen. So I think people are feeling a little bit more confident that now house prices are rising a little bit again. People know that we've kind of passed the bottom of the market. So that's bringing a little bit more confidence around this year too.
Well, I'm pleased you brought it round to house prices, because I was going to say, could we mention house prices? So you've started us off there. What else would you add on kind of how the market's doing?
I think overall the final data for the end of last year probably show around about a 3% rise nationally. I think the start of this year, we were looking at similar 3 to 4, albeit with a slightly more volatile time in the first quarter due to the stamp duty deadline, etc. Again, it will vary regionally. I think if you're, for example, a buy-to-let investor, we're seeing a lot of buy-to-let investors move to company structures, as Hamptons told me, as Aneisha's data told me. But in places where buy-to-let is kind of big in those less expensive markets, so for example, up in the northeast, we're likely to see further investment there, pushing house prices further, whereas prices in more expensive areas, again, will have that smaller, lower growth, perhaps. I don't know how you guys feel about that. Maybe you feel differently, but...
Yeah, broadly, I think we're kind of at the point where when you look at the Great Britain average house price, it's back to a new peak. So we've recovered from the price falls in 2023 and most of kind of 2024. The places that haven't recovered are London and the southeast. So there's still a little bit of recovery there and a bit of catch up. It's a really difficult one, I think, over what regions we're going to see the most house price growth from, because I think from an affordability perspective, you would absolutely say that it's still really challenging down south. That's going to suppress house price growth. Therefore, we'll see prices rise a little bit more in the north. But actually, when you look at house price growth as a measure of a year-on-year change, and when a market hasn't done very much for a year or probably 5-10 years if you're talking about London, sometimes you do start to see that kind of figure bounce back, and that's what we think we might get to towards the end of this year in London, and we might start to see London actually perform a little bit better than some of those other regions because of that. It's just got a bit of catching up to do, to say the very least.
It's been a brilliant episode. Thank you both so much for coming in today.
Oh, thanks,
Thank
Lucia.
you.
Thanks for listening to this podcast from Which, the UK's consumer champion. You can find plenty more advice about what we discussed today in the show notes. There you'll also find a link to become a Which member for 50% off the usual price, an offer exclusively available to you, our podcast listeners. Joining Which will not only give you access to our product reviews, our app, one-to-one personalised buying advice, and every issue of Which magazine across the year, but you'll also be helping us to make life simpler, fairer and safer for everyone. Don't forget to hit subscribe wherever you're listening. That way you'll be notified whenever we release a new episode of Which Money, Which Shorts, or any other podcast that we make for you. And if you want to get in touch with us, then follow us on social media at Which UK or drop us an email to podcast@which.co.uk. See you next time.
Every year, Which tests thousands of the products that you rely on every day. And we've been doing it for over 60 years.
Which reviews are 100% impartial. We don't accept freebies from manufacturers, and we have no owners, shareholders or government departments to answer to. So our work is on behalf of you, the consumer.
In a world of misleading claims and fake reviews, we test everything, from everyday items to big purchases, so that you don't have to.
We then put them through tests and assessments that go beyond the accepted standard to work out how well these products work for you and what's not worth your money. And a Which membership not only gets you access to our reviews, it also funds our non-profit campaigning work, like getting scam ads banned on social media and ending broadband and mobile mid-contract price hikes. And right now, podcast listeners can become a Which member for 50% off the usual price by heading to which.co.uk/podcast offer.